Guys, shall we start? Okay, see. We are in which section? Section 47. First exam transfer. First exam transfer. Maturity or redemption of sovereign gold bond in the hands of individual. That is an exam transfer. Second, conversion of bonds into new bonds or shares. Third one, conversion of preference shares into equity. Fourth, I will have to show you everything. Ma, very bad, very bad. What HAF? HEF. Here the cost was as per 49(2)(a), if you remember. Here the cost was as per 49(2)(ae). Okay, no? Here it was 49(1). Transfer of any capital asset by HUF to its members. Then we did the fifth transaction. Which was that transaction? Fifth transaction, guys. If any capital asset is transferred by any individual or HUF by way of gift, will, inheritance or irrevocable trust, then the transfer is an exempt transfer in the hands of individual or HUF. Yes or no? And this entire transaction we have done. Okay. Now coming to transaction number 6. Transaction number 6. Okay. There is a holding company. Which company? Holding company transferred any capital asset to 100% 100% subsidiary company. Subsidiary company, and this company should be an Indian company. Just remember this transaction. No need to get into details. So if there is a holding company has a capital asset, and that capital asset is transferred by the holding company to its 100% subsidiary company, and the company, transferee company, is an Indian company. Then this transfer is an exempt transfer in the hands of. Therefore, capital gain or no capital gain? No capital gain will be taxable in the hands of holding company. Can reverse transaction take place? Now this 100% subsidiary company has transferred any capital asset to its holding company. But this company, transferee company, must be an Indian company. Then so this transfer is also an exempt transfer. So this transfer is exempt transfer. This transfer is exempt transfer. And point number 6 and point number 7. Point number 6 and 7. Common point I am telling you. The capital asset transferred shall not be a stocking trade in the hands of transferee company. Meaning, if the holding company is transferring, then it should not be a stocking trade in the hands of subsidiary company. So it should go as a capital asset only. Yes or no? So if I am a holding company, you are a subsidiary company. I am giving you capital asset. So that capital asset should be a capital asset in your hands. It should not become stocking trade in your hands. If you are a subsidiary company and I am a holding company, if you are transferring that capital asset, then it should not be coming as my stocking trade in my hands. Yes or no? So in the hands of the transferee company, the asset should be transferred as capital asset. It should not be transferred in the form of stocking trade. Getting my point? Only then the transfer will be exempt transfer. Understanding? And here also refer section 49(1). Here also refer which section? 49(1). What is the meaning of 49(1)? Right now the transfer is exempt transfer. Yes or no? In the company, in the hands of transferor company. Right now the transfer is an exempt transfer. Now later on, the transferee company, is having that asset. Now what will be the cost of acquisition of this asset in the hands of the transferee company? Later on when the transferee company is transferring, cost to previous owner. Cost to previous owner, because the transfer was exempt in the hands of transferor company, so the gain would not have been taxed in the hands of transferor company. That gain should be taxable in your hands. So it will be taxable only if the cost to previous owner is taken as your cost. Do you remember 49(1)? Cost to previous owner will become your cost. Any cost of improvement of the previous owner will also become your cost. Yes or no? Period of holding of the previous owner will also become your period of holding. And indexation, if available, will be given for your period of holding. But if you apply the judgment of Manjula Ben Shah, then the indexation will be given from beginning. Do you remember that? So wherever 49 will come, this discussion is going to happen. Understanding? Now 7 transactions done. Okay. Now 8th transaction. What is that 8th transaction, guys? Guys and girls, if there is an amalgamating company. So transfer of any capital asset by an amalgamating company to amalgamated company in the scheme of what? Amalgamation. So amalgamation is taking place. One company is getting amalgamated with another company. So in the scheme of amalgamation, the amalgamating company's business will go to amalgamated company. So in the course of that, the capital assets of the amalgamating company will also be transferred to amalgamated company. Yes or no? But that amalgamated company should be an Indian company. The transferee company must be an Indian company. So any capital asset transferred by this amalgamating company to the amalgamated company in the scheme of amalgamation, sir, this transfer is also an exempt transfer and the capital gain will not be calculated in the hands of amalgamating company. Yes or no? Next one. Here no, here sir. Here also what you have to refer? Refer section 49(1). So later on, when the same assets will be sold by amalgamated company, then what will be the cost of acquisition in the hands of amalgamated company? The cost of acquisition in the hands of amalgamating company, previous owner will be deemed to be the cost in the hands of amalgamated company. Yes or no? Now, have you heard about demerger? One company, which is a big company, is split into 2 parts. One company doing business, unit 1, unit 2, 2 businesses are done. But a new company is formed and unit 1 business is transferred to new company, resulting company in the scheme of demerger. So demerger is taking place. Entire business is split into 2 parts. Understanding? Earlier, both the businesses were done by single company. Demerged company. What will you call it? Demerged company. The company whose demerger is taking place. Yes or no? That company is known as demerged company. So now my demerger is taking place. Earlier I was doing how many businesses? 2 businesses. Unit 1 and unit 2. 2 businesses I was doing. But my demerger is taking place. A new company is being formed. That company is known as resulting company. So one of my business is transferred to that resulting company known as resulting company. Okay. And in that company, whatever business is transferred, so along with the transfer of business, the capital asset will also be transferred. And this is a transfer happening in the scheme of demerger. And this transfer will also be exempt transfer. Will you remember this? So what is being transferred, sir? Transfer of any chartered accountant. No, capital asset. By a demerged company. By a demerged company to the resulting company. To the resulting company in the scheme of what? Demerger. Okay, so in the scheme of this demerger, whatever transfer is taking place, that transfer will be taxable transfer, no? Or exempt transfer, sir? Sure, 100%. Should I lock the answer? Pakka. Very good. You all are superstars, huh? You have become so smart. I must tell you. Congratulations. So, who is transferring? Just now I said that you have become smart. Just now. 1 second back. And giving bullshit answers. Smart people give smart answers. Hello, smart people. Who is transferring? Demerged company is transferring. So this transfer is an exempt transfer in the hands of demerged company. If the transfer is taking place in the scheme of demerger, okay, to the resulting company. But sir, that resulting company must be an Indian company. Yes or no? So this transfer will be an exempt transfer. Have you understood this? Sir, here, underline. What will I write? Refer section 49(1). So now whenever the resulting company will transfer that asset in the future, what will be the cost of acquisition? Cost to previous owner. So cost of acquisition in the hands of demerged company will be deemed to be the cost in the hands of resulting company, and all the provisions of section 49 will apply there also. Yes or no? So did you see how many places section 49(1) is coming? Section 49(1) is coming starting from transaction number 4. HUF to member on partition. Section 49 will come in the hands of member. Then an individual or HUF transferring the asset to any person as gift, will, inheritance, irrevocable trust. That at that time, in the hands of transferee, the person to whom the asset is gifted, yes or no? In the hands of that transferee also, section 49 will apply. Cost to previous owner. Cost of this individual or HUF will be deemed to be the cost in the hands of transferee. Yes or no? Then holding to subsidiary, subsidiary to holding, then amalgamating company to amalgamated company, then demerged company to resulting company. In all these transactions, section 49(1) will follow in the hands of resulting company, or in the hands of amalgamated company, or in the hands of transferee company. Getting my point? Everyone, did you understand? Now transaction number 10. Transaction number 10. Now this transaction is a little bit important transaction. Please pay attention. Okay. See, transfer of shares. Transfer of by the shareholder shares in amalgamating company in lieu of shares in amalgamated company in the hands of shareholder. Sir, even this transaction is also an exempt transfer. Sir, even this transaction is an exempt transfer. No capital gain will be calculated. Now, if anyone can explain me, which asset is getting transferred? Shares of which company is getting transferred in lieu of shares in? So you give the shares of amalgamating company, in return you are going to get shares of amalgamated company. If you are a shareholder and the amalgamation is taking place of your company, so now the company whose shares you are holding, that company is getting amalgamated. Yes or no? So now you will have to surrender your shares of the amalgamating company, and in return you are going to get shares of amalgamated company. So possible that, see, this fellow, this person, what is the name of this person? Mr. Kamal. Hello, Kamal. Kamlesh, there or not? You are having how many shares? 1,000 shares. Of which company? X Limited. Which Kamal had acquired in the previous year? 9-10. When did Kamal acquire them? Previous year? 9-10. So in previous year 9-10, Kamal acquired them, and the actual cost. What did I say? Actual cost of these shares. AC. AC means actual cost of these shares was 1 lakh. Now what Kamal will do? Kamal will give these shares. Okay. Kamal will give these shares. So these shares will be surrendered. And in lieu of these shares, the Kamal will get what? New shares. Getting my point? So in return, Kamal is getting 1200 shares. 1200 shares of which company? Y Limited. Now, sir, what is X Limited? X Limited is an amalgamating company. Amalgamating company. The shares of amalgamating company will be given. And in return, he is getting what? 1200 shares of Y Limited, which is amalgamated company. Yes or no? And now, for example, the value of these shares. And this is happening on, for example, in previous year 17-18. So in the year 17-18, the amalgamation is taking place. So in the scheme of amalgamation, entire business of amalgamating company will go to the amalgamated company. Yes or no? And the shares of the amalgamating company will also get the shares of amalgamated company, because you are no more the shareholder of amalgamating company. That company ceases to exist now. So please surrender your shares, and in return you are going to get the new shares of amalgamated company. Getting my point? So 1000 shares you had to surrender those 1000 shares, and in return you are getting 1200 shares of which company? Amalgamated company. Yes or no? So here the amalgamated company shares, the market value of these shares as on the date on which they are given, the market value was 1,80,000. So now tell me, Kamal is having a gain of rupees 1,80,000 or not? Sorry, 80,000 or not? He is giving shares worth 1 lakh, and in return he is going to get the shares worth 1,80,000. So shares of 1 lakh is given, and in return he is getting the shares of Y Limited, which is valuing 1,80,000. So 80,000 gain is happening to him. Should this 80,000 be taxable to him? Yes, but not right now. Because right now, at the time of surrendering the old shares and getting these shares, this 80,000 gain is not realized and not coming in his pocket. When this 80,000 gain will come in his pocket? When he will sell these 1200 shares in the future. Now, for example, these shares, these 1200 shares, okay, no? These 1200 shares are later on what? Sold. Sold in previous year 25, 26. And the selling price was, example, 3 lakh rupees. How much? So can I say from here to here there is a gain of 1,20,000? Hello? From 17-18 to 25-26, the value of the shares have been increased by 1,20,000. That appreciation will also be realized. And don't you think this appreciation will also realize? So how much is the total appreciation? 2 lakh. That will be realized when he will sell the 1200 shares. So now tell me, here in the previous year 25. So first of all, in the previous year 17-18, that is assessment year 18-19, a transfer is taking place. In this year, what transfer is taking place? Shares of old company given, and in return shares of new company coming. Yes or no? This transfer is taking place. Surrender means extinguishment of, right? Yes or no? So extinguishment of right is taking place, transfer is taking place, but on this transfer, whatever gain is there, that gain is not realized. So that gain will be taxable or will not be taxable. In this year 17-18, the gain will not be taxable. In this year, the transfer will be treated as exempt transfer. Yes or no? So here what I will say? Tell me. Transfer of shares. How many shares? 1000 shares of transfer of how many shares, sir? 1000 shares of X Limited in lieu of. In lieu of means in return of. Yes or no? In return of 1200 shares of Y Limited by the shareholder. Who was the shareholder? By Mr. Kamal. By Mr. Kamal shall be, sorry, in the scheme of amalgamation. Yes or no? In the scheme of amalgamation shall be treated as what? Exempt transfer under section 47. Therefore, capital gain will arise or will not arise? Will not arise. In the year 17-18, capital gain will not arise. But whatever capital gain which was exempt at that time, will you realize later on? So should be taxable later on. So for that, what should be the cost of those 1200 shares? Whenever you will sell the 1200 shares of Y Limited, at that time you are going to calculate the capital gain also, no? So what will be the cost of those 1200 shares of Y Limited? Nil. No, it will be 1 lakh. Cost of the old shares will be deemed to be the cost of new shares. And also the period of holding of old shares will be included in the period of holding of new shares. Same logic, no? Hello? Understand then okay, otherwise magic. Understanding the logic? Then okay, otherwise magic. Okay, now in which previous year? Come on, tell me. Previous year 25, 26. That is assessment year 26, 27. Kamal is going to sell the what? Shares. So sale of which shares? Which shares Kamal is having now? Old shares. Old shares already transferred. Transfer was exempt, and in lieu of old shares, new shares are received. So now Kamal is holding which shares? New shares. 1200 shares of Y Limited. So sale of how many shares? 1200 shares of amalgamated company Y Limited. Okay, is equal to which transfer? Taxable transfer. And if it is a taxable transfer, capital gain will arise or will not arise? Capital gain will arise. And that capital gain, to calculate that capital gain, what are we going to do, guys? FVC. That is selling price. At what price it was sold? Come on, tell me. 3 lakhs. So 3 lakh will be the full value of consideration minus transfer expense. How much is the transfer expense? Dash. So net consideration will be 3 lakhs. Now, sir, what will be the cost of acquisition? Just a second, huh? Just a second. This transaction was there, no? One second. This is sovereign gold bond is done. Okay, self-acquired property. Okay. Okay. Done. So, cost of acquisition will be as per which section? 49. 149 slabs you will get now. Is there any previous owner, current owner? Asset is transferred by way of gift, will, inheritance? No. Transferred by a holding company to subsidiary company, transfer of asset by an amalgamating company to amalgamated company, transfer on demerger, all these transactions are there. Kamal is the owner. Earlier he was holding old shares. Now he is holding new shares. Those new shares he is transferring. So he is calculating the capital gain of new shares. So what will be the cost of new shares? Sir, take fair market value no. 1,80,000. If you will take 1,80,000, you will get 1,80,000 slabs. Don't take this 1,80,000 because if you will take this 1,80,000 as a cost, so the gain will be only 3 lakh minus 1,80,000. Only this gain will be taxable. But we want to charge the earlier gain also, no? So that is possible if the cost, only if the cost of the old shares is made the cost of new shares. And that is not given in 49.1, that is given in 49.2. Where it is given? So the cost of acquisition will be under section 49.2. And what 49.2 says? 49.2 says cost of 1,000 shares. 1,000 shares of what? X Limited shall be what? Deemed to be what? Cost of acquisition of 1,200 shares of Y Limited, whose capital gain you are calculating right now. So as per 49.2, the cost of old shares will be deemed to be cost of new shares. Yes or no? Only then the earlier gain which we exempted will also be taxed in your hands. Getting my point? So what was the cost of those shares? 1 lakh. That 1 lakh you are supposed to reduce. Understanding or not? So how much is the capital gain? Now tell me, which type of capital gain is this? Short term or long term? For this you will have to check period of holding. Sir, period of holding of the new shares no started from 17-18. Okay. So previous year 17-18 to previous year 25-26. Date of acquisition to date of transfer. But only the gain of this period is getting taxable, or gain of the earlier period is also getting taxable? So why are you taking the period of holding from here? Also include the period of holding of old shares in the period of holding of new shares. So instead of taking the period of holding from 17-18 to 25-26, take the period of holding from 9-10 to 25-26. Understanding? So we are going to take the period of holding from previous year 9-10, meaning the date of acquisition of your old shares. From that date till the date of transfer of new shares, the entire period of holding you are supposed to take. Getting my point? And based on that period of holding, now tell me, the asset is short term or long term? Long term. Since the period of holding was more than, why 24 months? Because nothing is mentioned, shares are unlisted. And if the shares are unlisted, you check 24 months. Yes or no? Therefore, the capital gain is what? Taxable long-term capital gain under section 112. On this gain, how much tax you are going to pay? 12.5% without indexation, or 20%. 20 slabs you will get. That you do only in the case of immovable property. Only if you are a resident individual transferring what? Immovable property on or after 23rd July 24, which you acquired prior to 23rd July 24, only in that case you have the option to calculate long-term gain with indexation, and on that you have the option to pay 20%. Rest in every case the gain will be taxable at 12.5% and will be calculated without indexation only. Understood or not? Easy or difficult? Easy? Sure? Okay. So how many transactions we have completed, sir? 10 transactions. Sir, in this transaction, no, I have to refer one section. Refer which section? 49.2. And 49.2 will be applicable to the cost of new shares. What will be the cost of new shares? As per 49(2), it will be the cost of old shares, which will be deemed to be the cost of new shares. And also the period of holding of old shares will be included in the period of holding of new shares. Understanding? Manjula Ben judgment will be there. All those things will be there. Only 49(1) is there. Cost of previous owner will be there. No, only previous owner. 49(1) gets applied. Only then talk about those things. Understanding or not? Will you remember this point? Sure, no, everyone? Okay. Now 10th point is done. See, we have completed these many things. Huh? Okay. See this. Till here, yes. This transaction we have already completed. Okay. This example already we have taken. And okay. Now there is one important discussion which I would like to do. What important discussion? Please pay attention. Huh? So, see. Sir. This is my assessee. Okay. Name of the assessee is Mr. Gokul. Gokul, you are an employee, huh, Gokul? Gokul, you are an employee. Employee of which company? Gokul, take the name of any company. Tata, okay. Tata Limited. So there is a company Tata Limited who is the employer. Okay. And Gokul is the employee of this company. Do you remember salary head? We have done 5 lakh years ago. At the time when dinosaurs were alive. Yes or no? Do you remember something? In that age, when dinosaurs were alive, at that time, we did salary chapter. In that salary chapter, I told you that whenever the employer gives shares as sweat equity shares or shares or securities under ESOP, do you remember that? Either it will be given free of cost or it will be given at concessional price, that is treated as a perquisite in the hands of employee. So, my dear employee, my dear Gokul, are you getting what? Shares or securities under ESOP, or you are getting sweat equity shares from your employer? Yes or no? Now see, will it be a perquisite? Tell me yes or no. Will it be a perquisite? For whom? Employee. Under section 17, subsection 2, clause 6. This will be a perquisite. How to determine the value of this perquisite, guys? How you determine the value of this perquisite? Come on, tell me. Forget it, nah? I know. The fair market value as on DOEO. Sir, what is this DOEO? Date of exercise of option. Do you remember? As on the date of exercise of option, Gokul will exercise the option. Gokul will go and tell the employer that employer, see, I am eligible to get sweat equity shares. I am eligible to get ESOP shares because certain conditions which you have specified, I have satisfied all those conditions. So now I am eligible to get the sweat equity shares or securities under ESOP, and I am exercising my option to buy them. So the date on which the Gokul will go to buy these shares or securities, the date on which he will exercise the option, on that particular date, whatever is the fair market value. Yes or no? Let's take an example. The fair market value was rupees 1500 per share. 1500 per share. So that fair market value will be taken to value this perquisite. Yes or no? Minus what? Minus amount recovered by the employer. So whatever exercise price which Gokul will pay to the company. Company has said at the time of exercise of option you will have to give this much price. So that is what? Exercise price. That is nothing but the amount recovered from the employee. Yes or no? So amount recovered by the employer is nothing but exercise price. and this exercise price, for example, was rupees 500 rupees. So how much Gokul gave at that time? And Gokul got a share whose value was 1500. So how much benefit happening to Gokul? So this is the taxable value of Perquisite under the head PGBP or under the head salary. So Gokul will have to show this 1000 rupees as his Perquisite under the head salary multiplied by number of shares for which the option is exercised. So this is benefit per share, yes or no? 1000 rupees per share multiplied by number of shares for which the option is exercised. For example, he is exercising the option for 200 shares. How many shares? So per share, how much benefit is happening? 1000. So for 200 shares, how much benefit will happen? So this 2 lakh will now be treated as his taxable value of Perquisite under the head income from salary. Now this will be taxable in which year? Come on, tell me. This will be taxable under the head salary, but taxable in previous year in which he has exercised the option. No, the shares are allotted. In which shares are allotted. Done, sir? Yes or no? So let's take one example that in this case the date of exercise of option. He exercised this option on 19th of June 2025. So date of exercise of option is 19th of June 2025. To value this Perquisite, always the fair market value as on that date. Yes or no? And these shares are allotted. These shares are allotted. Allotted, for example, on 5th of August 2025. So now tell me, when the option was exercised? Previous year, 25, 26. And in the same year, previous year, 25, 26, the shares are allotted also. So can I say this 2 lakh will be taxable under the head salary in which year? Taxable in which year? Come on, tell me. Previous year, 25, 26, because in this year only the shares are allotted. Understood? Yes or no? Yes or no? Now in this year, Gokul has received the shares or securities under ESOP or as sweat equity shares. Yes or no? Now can I say these shares are capital asset for Gokul now? Now what if Gokul sells these shares in the future? Will he calculate capital gain? Sure, no? So let's say if, what did I say? If the above shares, if the above shares are sold by Mr. Gokul on 18th of February 2026. Can I say in the same previous year he is selling? Previous year 25-26, same previous year he is selling also. So in this year he is receiving as Perquisite. He is becoming the owner of this capital asset, yes or no? And in the same year he is selling also. Possible or not possible? So now if the above shares are what? Sold by Gokul. Can I say these shares are capital asset for Gokul? Sold means transferred. So Gokul is transferring a capital asset. Will Gokul calculate the capital gain? Therefore, capital gain will be calculated in the hands of Gokul. Done, no? Now to calculate the capital gain, full value of consideration. But wait, wait. Some information, more information. See, he is selling them on 18th of December for a selling price. Selling price of rupees 2000 per share. How much is the selling price? And the fair market value as on 18th of February 2026 26 was 2100 per share. And why I have given this fair market value? If someone will tell me, no, I'll be more than happy. Why I have given this fair market value? Selling for how much? Sale price is, and on that day the fair market value is, selling price is more, no? Or less? Fair market value is high. Do you remember something? What? Section 50CA. If the consideration for transfer of shares other than quoted shares is less than their fair market value as on that day, then the consideration will be ignored and the fair market value will be deemed to be the full value of consideration. We have done it so many years ago. Yesterday only I have discussed this point. So Gokul is selling the shares. Yes or no? Are these shares quoted shares? Not given, meaning the shares are other than quoted shares. And if the fair market value calculated as per prescribed rules is given in the question and that fair market value is higher than the selling price, then selling price cannot be taken as full value of consideration. 50CA will apply, and as per 50CA, the fair market value will be deemed to be the full value of consideration. Yes or no? So now capital gain will calculate, and to calculate the capital gain, full value of consideration will be what? Tell me. Sale consideration is less than fair market value. What is the sale consideration? 2000. What is the sale consideration? 2000. What is the fair market value? 2100. Yes or no? Therefore 50 CA will apply, and fair market value deemed to be what? Full value of consideration. So tell me, what will be the full value of consideration? 2100. How many shares? 200 shares. Yes or no, Gokul? How many shares? 200 shares were there, no? Sir, 200 shares were there, no? So 200 shares you are selling, the above shares, 200 shares you are selling for 2000 rupees per share, but the fair market value is 2100. 2000 will be ignored and 2100 will be taken as your full value of consideration per share. How many such shares? 200 shares you are selling. So what will be the full value of consideration? 2100 into 200 shares. Yes or no? Tell me how much? 4 lakh? Good number. 420. Less what? Transfer expense. Gokul, any transfer expense, buddy? Bro? Any transfer expense, bro? No. So net consideration is 4,20,000 minus what? How much Gokul gave to that company to buy the shares? Tell me. 500, no? So what is the actual cost? 500 will be the cost of acquisition. But if you will take that actual cost now, what will happen? The amount which is already considered as your perquisite and already taxed under the head salary will be taxed for the second time in the form of your capital gain. You want to pay tax on this 1000 rupees under the head capital gain also, no? So don't take 500 as cost. Take 1500 as cost. The fair market value of these shares as on the date of exercise of option, which was considered to value the perquisite, will be deemed to be the cost of acquisition as per section 49 2AA. 2AA. So cost of acquisition will be as per section 49 2AA. And what 49 2AA says? The fair market value as on date of exercise of option, which is considered for what? Considered for valuation of what? Perquisite under section 17 subsection 2 clause 6 shall be what? Shall be deemed to be what? Cost of acquisition of such shares. So now tell me, what was the fair market value? 1500 multiplied by how many shares? 200 shares. How much? 3 lakhs. Reduce this 3 lakh. How much you are going to get? 1 lakh, and this 1,20,000 will be long-term capital gain, no? 1,20,000 will be long-term capital gain, no? How will you find out that which type of gain is this? You will check the period of holding of the shares. So, Gokul, when the period of holding will start? When you exercised the option, that time the shares came to you? Or when the shares allotted to you, that time the shares came to you? So date of allotment is the date on which you became the owner of the shares. So that is the date on which he started holding the shares for the first time. From this date till the date of sale. Understanding? Till the date immediately preceding to date of transfer. Getting my point? So the period of holding will start from this is what? This is taxable short-term capital gain at normal rates. Why short-term capital gain, sir? Why short-term capital gain, sir? The period of holding you are going to take from which date? 5th of August 2025. Date of allotment, and not from the date of exercise of option. Till the date of transfer, 17th of February 2026. Getting my point? So this period of holding is less than how many months? 24 months. Because the shares are unlisted shares, I'll check 24 months. And if this is less than 24 months, hence the gain is short-term capital gain. Will you be able to calculate like this? Hello? What was this? The shares received on as sweat equity shares. Shares which are received or securities which are received under ESOP, for which the perquisite is already valued and charged in the hands of the assessee. Now that same shares the assessee is transferring in the future. So to calculate the capital gain of those shares, what will be the cost of acquisition? 49 2AA, which says that fair market value as on the date of exercise of option, which was considered for valuation of perquisite under section clause 6, shall be deemed to be the cost of acquisition. Simple, no? Apply some logic. Okay, guys, tell me what amount you paid for the shares. So your actual cost was 500. From your pocket, how much you paid? 500. And what was the fair market value? 1500. And this is the fair market value as on the date of exercise of option. And you are selling the shares for 2000 or 2100. Yes or no? Whichever is higher. So you are selling the shares for 2100. Yes or no? So tell me, from here to here, how much gain? 1000. Yes or no? Which is already taxed under the head income from salary. So now the gain from here to here only should be taxable under the head capital gain. Yes or no? Hello? So what is that gain? 600 rupees. Understanding? So total gain is how much? 1600. 500 you are buying and 2100 you are selling. Yes or no? What is the total gain? 1600. Out of that 1600, 1000 is already taxed under the head salary as your perquisite. So now under the head capital gain, how much should be taxable? 600. 600 into 12, sorry, 600 into 200, 1,20,000. That is getting taxable. See? But if you will take 500 as cost, what will happen? Again this 1000 will be taxable under the head capital gain, which is already taxed under the head salary as your perquisite. So you want to pay tax twice on this 1000? Then ignore that portion. No, take the fair market value as your cost of acquisition, 49,288. Understood? Sure? Should I move ahead? Now see, earlier what used to happen, no? Pay attention. Huh? Have I told you that if any individual or HUF is transferring any capital asset by way of what? Gift, will, inheritance or irrevocable trust, then transfer of that asset is exempt transfer. Yes or no? Earlier what used to happen, that if the ESOP shares are there, shares or securities under ESOP or sweat equity shares are there, these shares are transferred by way of gift or irrevocable trust. These shares are transferred as gift or irrevocable trust. That transfer was not exempt earlier. Last year one amendment came, and from last year onwards, even the transfer of these shares by way of gift or irrevocable trust is also treated as an exempt transfer. So what was happening earlier? I am telling you the old scenario. Earlier what used to happen? Earlier any capital asset. What did I say? Other than shares received under ESOP or sweat equity shares. I am talking about any capital asset other than these shares. Okay, no? If these capital assets are transferred by way of gift, will, inheritance or irrevocable trust, then this transfer was what? Exempt transfer. Under section 47, and no capital gain was taxable. No capital gain was taxable. I am telling you the old situation. Yes or no? But last year only one amendment has come here. So right now the situation is something different. Yes or no? And earlier what used to happen? Earlier what used to happen? The shares. What did I say? So this was about any capital asset. This was about any capital asset other than the shares received under, shares or securities received under ESOP or sweat equity shares. Any capital asset transferred by way of gift, will, inheritance or irrevocable trust, the transfer was exempt transfer, capital gain was not there. But if the capital asset was shares or securities under what? Under ESOP or sweat equity shares were there, and if these shares are transferred by way of what? Gift or irrevocable trust and will or inheritance. Yes or no? This transfer was not treated as exempt transfer under section 47, and capital gain was calculated here. Here the capital gain was calculated. And if they were transferred by way of will or inheritance, then it was your exempt transfer under section 47, and no capital gain was taxable at that time. Did you understand? But now what is the situation? Last year only the amendment has come. And now all capital asset, including these type of shares, transferred by way of gift, will, inheritance, irrevocable trust, the transfer is exempt transfer. So now what is the situation? Now, current situation? I have told you the old situation, yes or no? But last year amendment has come, and what is the situation as of now? So I will write down current situation. This is same. This is what? Same. So I will copy and paste. This is same. I will just change the color. Current situation is same. Any capital asset other than shares received under ESOP or sweat equity shares transferred by way of gift, will, inheritance, irrevocable trust, exempt transfer, capital gain will not be taxable. But earlier what used to happen? These type of capital asset whose gift or irrevocable trust was not exempt earlier will now be exempt. So now color, blue color. If they are transferred by way of what? Gift or irrevocable trust, or even they are transferred by way of what? Will or inheritance. Getting my point? Color, blue color. In both the cases, what did I say? In both the cases, the treatment will now be same. What is the treatment? The transfer will be treated as exempt transfer and capital gain will not arise. Understanding? And do you remember the color, green color, which question I solved? This question. In this question they are telling you the shares are taxable transfer. Hence you are calculating capital gain. What if Gokul would have given these shares as gift? Earlier that gift was not exempt transfer. And now Gokul is giving these shares as a gift. Then the transfer is exempt transfer. Understanding? So my discussion will move on. Color, green color. In the above case, what did I say? In the above case, comma, if Mr. Gokul had transferred the above shares, which he received on what? Received from his employer as sweat equity shares or under ESOP. Yes or no? So the above shares on what? 18th February 2026. On that same day, instead of sale, if it was transferred by way of what? Gift, will, inheritance or irrevocable trust. Then such transfer is equal to what? Exempt transfer under section 47, and therefore capital gain will be calculated or will not be calculated? Will not be calculated. Capital gain will be calculated only if these shares are transferred by way of a taxable transfer, meaning sold. But if these shares are also given as gift or irrevocable trust or even as will or inheritance, the transfer of these shares will also be exempt transfer. Understood? Sure, sir. This type of small question they can ask you for 2 marks MCQ. So therefore, no capital gain will arise. But will the capital gain arise in the hands of that person to whom the asset is gifted? Yes. And for that, 49(1) will be applicable. Because these shares are gifted by Gokul. For example, Gokul has gifted these shares to his younger brother. Okay, no? Younger brother is Krishna, example. So now the shares are gifted to Krishna. Transfer by Gokul will be an exempt transfer under section 47. Now who is having those shares? Krishna. Will Krishna sell the shares in the future? For 3,000 rupees. How much? So full value of consideration 3,000 minus transfer expense. Nothing, no transfer expense. Net consideration. What will be the cost of acquisition in the hands of Krishna? Krishna has received the asset by way of gift. Mode specified under section 49.1 from his brother. Yes or no? 49.1 will apply. Which section will apply? And as per 49.1, cost to previous owner, Gokul. What was the cost? Fair market value as on the date of exercise of option. As per 49.2AA. Yes or no? That was the cost of acquisition in the hands of Gokul. 1,500 will be deemed to be the cost of acquisition in the hands of Krishna. Understanding? So, Gokul has transferred by way of gift will irrevocable trust. Then such transfer is an exempt transfer in the hands of Gokul. But in the hands of transferee, meaning his brother, section 49.1 will apply. And as per 49.1, cost to previous owner, cost to Gokul, which was 49.2AA, 1,500, fair market value as on the date of exercise of option, will now be deemed to be the cost in the hands of Krishna. Whenever the Krishna will calculate the capital gain, at that time, what cost he is going to reduce? Cost to previous owner, which was 1,500 only. Got it, sir? Will you remember this? And sorry, the period of holding of Gokul will also be included in the period of holding of Krishna. And indexation only if indexation is there. Okay, no? Indexation only for the period of holding of Krishna as per law. But if Manjula Ben judgment is applied, indexation will be available for the period of holding of Gokul also. But that is not the case anymore because indexation will no more be available. Understood or not? Sure, sir? Okay, very good. Now see, we have done how many transactions? Sir, we have done how many transactions? Tell me. 10 transactions we have done, no? Okay. Now, one interesting thing. See, this is Mr. A. Mr. A has a capital asset which was given as gift to Mr. B. Possible? So now who is the owner? B. Who is the previous owner? So cost to previous owner will become cost in the hands of Mr. B. Simple, no? This is the simplest transaction, okay? But let's make it a little bit more simple. B is further giving the asset by way of will to Mr. C. And Mr. C is also giving the asset as a gift to Mr. D. And now D is selling the asset. Who is the assessee selling the asset? So for Mr. D, the capital gain will be calculated. So since Mr. D is selling what? Capital. Shares. How come shares? That discussion is over, macha. Shares. I'm talking about capital. See, color blindness. Color you cannot see. Here it was color, green color. Discussion is done. I'm saying that I'm doing a new discussion. Shares are gone, sir. Now I'm having a new discussion. Any capital asset. Any capital asset. Mr. A had acquired that capital asset. Yes or no? And now A has given that asset as a gift to B. B has given that asset to C. B has sold? No. B has also given as will. Now the asset is coming to C. C is selling the asset? No. C is also giving the asset as gift to D. Now tell me, transfer by A. A is doing which transfer? exempt transfer? Yes or no? Will there be, first of all, can I say section 47 will apply here? A is doing an exempt transfer. Capital gain will be there or will not be there? For B? For B, same, no, 47 will apply and there will be no capital gain in the hands of B also. And can I say this will be same for C also? Because C is also making a exempt transfer. So sir, A is doing an exempt transfer, so the transfer is exempt, no capital gain. Sir, B is also doing an exempt transfer, yes or no? So no capital gain in the hands of B also. Sir, C is also doing an exempt transfer, so no capital gain in the hands of C. Now who is making a taxable transfer? D. D is selling the capital asset, therefore it is a taxable transfer. Done, sir? Now, will D calculate the capital gain? D will calculate the capital gain or will not calculate capital gain? D will calculate the capital gain. Now, D will take full value of consideration, selling price minus transfer expense, net consideration. What will be the cost of acquisition for D? Sir, D has acquired the asset by way of gift. See, D has acquired the asset by way of mode specified under section 49(1). Cost to previous owner as per 49(1) will be deemed to be cost in the hands of D. That is sure. Because D has acquired the asset by way of gift. And gift is a mode specified under section 49(1). So I will have to take cost to the previous owner as the cost in the hands of D. Is it done? Which previous owner? C, B, A. Now there are multiple previous owners. You will take the cost of that previous owner who acquired the asset by way of any mode other than 49(1). Cost of that previous owner. What did I say? Cost of that previous owner who acquired the capital asset by way of any mode other than 49(1). Can I say C's cost will not come? Because C has acquired the asset by way of will, which is a mode specified under section 49(1). B's cost will also not come. Why? Because B has also acquired the asset by way of mode specified under section. Cost of A will come. Because A had purchased the asset. And purchase is not a mode specified under section 49(1). So cost of A will be deemed to be the cost in the hands of D. That previous owner who acquired the asset by way of any mode other than 49(1). And by doing this, what will happen? No, whatever gain which was exempt here, whatever gain which was exempt here, whatever gain which was exempt here, all the gain which is realized in the hands of Mr. D will be taxable in the hands of Mr. D. Understanding? So, period of holding of A also, period of holding of B also, and period of holding of C also will also be included in the period of holding of D. So, capital gain calculation in the hands of D. Okay, no? So, cost of acquisition for D is equal to what? 49(1). 49(1), which says that cost to previous owner. Which previous owner? Previous owner who acquired the capital asset by way of any mode other than what? 49(1) will be deemed to be the cost in the hands of D. That is cost of acquisition of Mr. A will be deemed to be the cost in the hands of Mr. D. Done, sir? And period of holding of capital asset of Mr. A plus Mr. B plus Mr. C plus Mr. D. All the period of holding will be included. Understanding? So what are you going to do? Start from date of acquisition. By whom? By Mr. A. Till date of transfer by Mr. D. This will be the period of holding. Understood? Indexation for your period only. If indexation is there, in case, yes or no? But if you will apply Manjula Ben judgment, then indexation from the beginning, with effect from the year in which Mr. A acquired the asset. But unfortunately, or fortunately, indexation will not be in your question. If it is there, in the case of calculating the capital gains, calculating the tax, in case of immovable property, you might have to do the indexation in that case. And indexation you will take only for D. That is correct, legally correct. As per law, that is correct. But if you apply the Manjula Ben judgment, you will divide the CII of which year? CII of the year in which Mr. A acquired the asset. From that year, you are going to get the indexation. Understood or not? Yes or no? So what will be the period of holding? What will be the cost of acquisition? If this type of situation they give you in the question, what are you going to do? So these are all, tricky points where the examiner can fix you in the exam. And if you will not pay attention over here, there might be a question in the exam where two previous owners are given. Mr. A has given to B and B has given to C. And assessee is C. C is selling the asset. Entire question is framed like that. What are you going to do? Cost of acquisition for Mr. C will be what? Cost to Mr. A will be deemed to be cost in the hands of C. At the most, 2 or 3 previous owners they can give in the exam. So in that case, you should be knowing that what is to be done in such cases. Done. If I skip all these points now, you will never come to know that these type of points are also existing. These kind of points can also be exploited in the exam. See, I have compiled few questions for your practice. Okay, no? Question bank. So I'll pass on that question bank today itself. Okay, Ritika, take from me. I'll pass on that question bank chapter wise. Chapter wise questions and answers. And those question answer will cover the ICI study mat questions also, and past exam questions also, MTPs, RTBs also. Few questions are framed by me. Those questions also you will see. Okay, and I have classified them into classwork, homework and class test section. 3 sections are there in each chapter. Chapter wise properly that is arranged. So today I am passing on that question bank to you. Okay, that was under preparation. That is done right now. Okay, so I'll pass on that question bank and see the questions of each chapter which you have solved, whether you are able to solve those questions or not. Few questions you will see, Ayo, this question I have already done in the ICI study mat. So I have taken good questions from ICI study mat also. Getting my point? So this question I have already done in the ICI study mat. This is already done in the class. No need to do that again. But if that question is good question, try to solve that question on your own. Because that question can also come in the exam. That is from ICI study mat. Getting my point? I have also taken past year exam question, few important questions from MTPs, RTPs and all. So those are all the questions. I guess near about 400 to 500 questions are there. All the chapters taken together. And that is enough for your practice. So start practicing from that question bank today itself. Okay. And in my last lecture now I will tell you that how to actually start studying for this subject, which you have not yet started, which you are going to start after your exams. Next attempt you are supposed to give, no? So I will be telling you from the point of view of next attempt, not for your attempt, because you are not serious for your studies. I can see that. Serious or not serious? Serious. How much serious? Very serious. So I will give you for this attempt also how you can study, but God forbid, if you have to give the next attempt, Then how are you going to study? That also you want me to tell you? No, sure. Then it is okay. Let's see. Okay. See now. What am I doing now? These important notes, no? Everything I have put. One small this thing. Should I confuse you a little bit? Confusion is required, no? This same thing. Same thing I will confuse little bit. If in the exam this type of thing is given, then what are you going to do? Now see, new transaction, new transaction. Mr. A, no? Mr. A has given the asset by way of gift to Mr. B. Mr. B has given by way of inheritance to Mr. C. Mr. C has sold. Mr. C has to Mr. D. Mr. D is giving as a gift to Mr. E, and E is finally selling it. Now who is the assessee? Who is selling the asset right now? So assessee is Mr. E. So tell me, since Mr. E sold the capital asset, that is which transfer? Taxable transfer. Done, sir. Capital gain will be calculated or will not be calculated? Capital gain for whom? Mr. E will be calculated, no? Now to calculate this capital gain, cost of acquisition which Mr. E will take. What will be the cost of acquisition? Come on, tell me. First of all, see, Mr. E has acquired the asset by way of gift, meaning a mode specified under section 49(1). So cost of Mr. E will be as per section 49(1). Guys, do you agree this? Now what will be the cost? Cost to, if multiple previous owners are there, then what we take? Cost to that previous owner who acquired the capital asset by way of any mode other than what? Section 49(1). Other than specified under section 49(1). Yes or no? So now tell me, for Mr. E, 1, 2, 3, 4 previous owners are there. Can I say D has acquired the asset? D has purchased the asset. So D has acquired the asset by way of mode other than 49(1). Yes or no? E has acquired the asset by way of inheritance, meaning a mode specified under section 49. C's cost cannot come. And B's cost can also not come. Because B has also acquired the asset by way of gift. It is a mode specified under section 49. So B's cost cannot come, C's cost cannot come. Can I say A would have also purchased the asset? Now there are two assessees. There are two previous owners who have acquired the asset by way of mode other than 49(1). And that is Mr. A as well as Mr. D. A has also purchased the asset and D has also purchased the asset. So out of these two, whose cost you are going to take? A's cost you are going to take or D's cost you are going to take? Latest previous owner. Latest previous owner is D. Because sir, gain of A, gain of B and gain of C, all the gain would have been taxed in the hands of C when C sold the asset. So this gain and this gain already taxed in the hands of Mr. C should not be again taxed in the hands of E. Getting my point? So which gain should be taxed in the hands of E? This to this and this to this. And for that, cost to Mr. D should be taken as cost in the hands of Mr. E. Latest previous owner. What will be the period of holding? Period of holding of E will also include the period of holding of D. All earlier period of holding you ignore. All the cost of earlier previous owners you ignore, because that entire gain would have already been taxed in the hands of C at the time when C sold the asset to D. Got it, sir? So which previous owner? Previous owner must be the latest previous owner. And in our case, that is Mr. A or Mr. D. Tell me which previous owner? Mr. D. So cost of acquisition in the hands of Mr. D will be deemed to be the cost of acquisition of Mr. E. And period of holding of Mr. D plus period of holding of Mr. E. Both the period of holding will be taken. So you are going to take period of holding from date of acquisition of the asset. By whom? By Mr. D till date of transfer by Mr. E. This will be your period of holding. Done, sir? Should I move on? Okay, perfect. 11 transactions we have completed, guys. How many transactions? Sorry, 10 transactions we have completed. Okay. Now see, one more transaction I am telling you. We are still in section 47. Section 47 is a huge section, I am telling you. So in section 47, different transactions are there. Exempt transactions, exempt transfers. And while doing those exempt transfers also, this kind of special things are arising. And this can be given in your question. And if you are getting all these things in your question, I should be making you ready for that. Okay. So now what is happening? See, this transaction I am going to tell you. But this transaction, no, you will be learning from me under the clubbing chapter. Which chapter? So right now I am keeping this transaction. This transaction you will learn under the clubbing chapter. So right now this transaction I am keeping pending. Okay. Here also 49(1) will apply. Okay. So when we'll be doing the clubbing chapter very soon, within 1 or 2 lectures we are going to start clubbing. In that clubbing chapter, I'm going to cover this transaction. Don't worry about this. Okay. Now one small last transaction is remaining. Last 1 or 2 transactions are remaining. Then section 47 will come to an end. Okay. So now see, transaction number 10 was there, no? Last transaction was transaction number 10, no? This transfer of shares in amalgamating company. Done, no? Now we are doing transaction number 11. What is happening? Okay. Now we are doing transaction number 11. Pay attention. Huh? You have electronic gold receipts. Again gone. EGR. EGR means electronic gold receipts. Have you heard about electronic gold receipts? Or first time you are heard? What is EGR? Tell me. Electronic gold receipts. See, company allots the shares. This is a company. For example, this is a company. Company will allot the shares to a depository. Depository is NSDL or CDSL. Now this NSDL or CDSL will convert the same shares in electronic form, demat form, dematerialized form. So NSDL, CDSL is a depository which keeps the shares with themselves. NSDL, CDSL is a depository which will keep the shares with themselves, and those shares which are there with the NSDL, CDSL will convert those shares in electronic form, meaning dematerialized form. And the shares which are held physically are converted into dematerialized form. Those shares will be traded in the market, stock exchange. So now these shares which are there with the NSDL, CDSL, same shares, color, Yeah, green color. Okay. These shares are physical shares. Physical shares allotted to whom? Allotted to depository. CDSL, NSDL. These shares will be converted into demat form. And now this demat form, meaning this electronic form, these shares will be traded. These shares will be traded in stock exchange. Buying and selling of these shares will take place. Understanding or not what is happening? Why this is done? Have you heard about Mr. Harshad Mehta? Harshad Mehta scam? What scam was there? Those shares were also traded in the market and kept as a security with the bank to get huge loans which the company never issued. Fake share certificates were made. And those share certificates, earlier the shares used to be held in physical form, paper form. So if a company has issued shares, so the company will issue the share certificate also. To whom? To the shareholder. Understanding? Now the shareholder will trade these shares in the stock exchange. And usually the settlement used to take a lot of time. And by the time you have bought, for example, you have bought some shares from me, and these shares are not held in dematerialized form, physical form. So now I will have to deliver that share certificate through the broker to you. And that share certificate will come to you, then at that time you will say, okay, now I am having these shares. And what used to happen? These share certificates which were physically issued by the company directly to the shareholders, the trading of these share certificates used to happen in the market. Now due to this what happened? The shares which are actually issued by the company, those shares were traded, but along with that some fake share certificates were also traded. People like Harshad Mehta, they used to get fake share certificates made, and they used to keep those share certificates as a security with the banks and to get huge loans. And those loans that Harshad Mehta used to pump in the market to increase the prices of shares. And by the time the profit is earned, he used to earn that profits, huge profits, and that profits, from those profits he used to pay the loan and he used to get back those share certificates. He used to do these transactions with every bank. Now, unfortunately, few trades went wrong in his case. So the bank seized those share certificates which he had kept as a security with the bank. And bank was asking for money. And Harshad Mehta was not able to pay that money. So what the bank said, okay, no problem. If you are not paying the money, we have your share certificates. We will sell these shares and we will realize our loan. When the banks went to realize that, what happened, you know? They came to know that these shares do not exist only, which have been kept as what? Security. Because these are all fake share certificates. Meaning those shares were also traded in the market and kept as security also sometimes, yes or no, which were never issued by the company. And that used to unnecessarily inflate the prices of the shares. And people like Harshad Mehta was playing big games like this. So that time when the scandal got exposed, no, that time the CDSL, NSDL and all these things came into picture. Now only those shares which are allotted by the company will be converted by these depositories. Those shares will not be allotted to any shareholder. This will be allotted directly to the NSDL, CDSL. So who will hold the physical shares? CDSL, NSDL. Now CDSL, NSDL will convert them into electronic form, in the demat form. Only those shares with the CDSL, NSDL will have allotted on their name will be converted into demat form and they will be traded in the market. So that those fake shares which were running in the market, which was being traded, which were being kept as security to fool the banks and all, yes or no, fool the lenders, those went out of the market. This was the reason for bringing this depository in picture. Right now there are only two depositories in India, CDSL and NSDL. You know the full form? Central Depositories of Securities Limited. NSDL, National Securities Depository Limited. These are known as depository. Now just like this same thing, a new concept has come. Few years back, a new concept has come. In that new concept, what will happen? A depository will be there. Who will be there? And this is a depository of gold. Okay. Now who can become this depository? What are these depositories? You are not supposed to get into details. So just like CDSL and SDL, a depository of gold is there. Now what this depository of gold will be having? They will have physical gold. They will have physical gold. Now where this physical gold will come? Either this depository will buy, or this physical gold will be given by investors like us. We are having so much of the gold. Yes or no? That gold we will give to this depository. That depository will keep that physical gold and convert our gold into electronic form, in the form of EGRs, electronic gold receipts. Or the gold which they will buy, the depository will buy, that gold which is bought by that depository also will be converted into electronic form, EGRs. So physical shares converted into electronic form, demat form by the depository. Just like that, physical gold is converted by the depository in what form? Electronic form. Yes or no? Same gold, but in electronic form. Same gold is there, but now that gold is held by that depository, and against that physical gold, huge vaults are there. This depository will own huge vaults, and in huge vaults, this physical gold will be actually stored. And against the gold which is there in the vaults, no, whatever gold they will be holding, against that the electronic receipts will be issued, and these electronic receipts will be traded in the market, just like gold. Right now, if we want to trade in gold, what we do? We deal in physical gold, and the prices of gold are manipulated or fixed by the gold association, bullion association. So we never know that on what basis that bullion association is fixing those prices. Prices of the gold should be based on demand and supply of the gold, no? And demand and supply of the gold can be better known if the gold is freely traded in the market in the form of EGR. So this will give a benchmark rate for the physical gold also. That rate which is fixed by bullion association. Getting my point? So now whenever you will go to buy the gold, no, you will have what? A benchmark rate. The rate of EGR that is purely depend on demand and supply. Based on this rate, you can also verify whether the rate which is quoted here for the physical gold is correct or not. Is it overvalued, undervalued? It will give you a benchmark. That way, the gold prices, whose complete control is there in the hands of bullion association, no, that will go out. And the gold prices will be effectively determined by market forces of demand and supply. And that is the reason why this depository system has come. Okay, so now tell me, do you have physical gold? Yes or no? You bought that gold in 2009-10. When did you bought that gold? 3 lakh rupees. How much gold? 3 lakh rupees. Yes or no? When did you buy that gold? Now, if you want, you can give that gold to this depository. This depository will convert your gold into electronic form and will issue EGRs in front of that. So wait. When did you buy that gold? What is the value of that gold right now? Example, today in 25-26, the value of that gold is 10 lakh rupees. So you will give that gold to depository right now. Against that you will get EGR. What is the value of that EGR which you will get? 10 lakhs. The value of the gold which is right now equivalent to that value, you will get EGR. This is EGR. It is as good as gold, but now you are holding the gold in physical form? No, electronic form. You have converted your gold into electronic form. Now carrying this gold anywhere in the world is the safest thing. Because now you don't hold physical gold. You can carry this gold anywhere in the world. Yes or no? Anywhere. Without even worrying about the safety of this gold. Now for example, you are in Bangalore. Okay, you have some gold in your hands and now you want to take this gold along with you to Mumbai. Will you carry this much gold with you? So risky. Convert it into EGR. And when you will reach Mumbai, no, give that EGR back and get your gold. That EGR can be converted into gold also. So physical gold can be converted into EGR and EGR can also get converted into gold. If you want, you can directly buy the EGRs also. You know that right now I don't want the physical gold, but in the future I would require physical gold for my daughter's marriage. So till that time, why to have physical gold and have that tension? Keep on buying EGRs. And your daughter, when she grows up, at the time of her marriage, give this EGR back to the depository, get that gold, and get the ornaments made for your daughter. It becomes very easy now. And these are freely traded. So, the demand and supply will decide the value of the gold now. So, did you have gold? Tell me. When you buy that gold? 9, 10. What was the cost of that gold? 3 lakhs, no? Right now, what is the value of that gold? When the value of that gold is 10 lakh, at that time you are getting it converted into. So can I say your gold which you acquired in 9, 10 at a cost of rupees 3 lakhs, that gold you are right now converting into EGR. Okay. It is converted into EGR. For example, it was converted in the last year, 24-25, when the value of gold was 10 lakhs. So when the value of the gold was 10 lakh, at that time you gave that gold to that depository, and against that gold whose value was 10 lakh, you will get the EGR whose value is 10 lakh. So now your 10 lakh worth of gold is getting converted into 10 lakh worth of EGR. One asset going, another asset coming. Gold is going, EGR is coming. How much worth of gold is going? 3 lakh. How much worth of EGR coming? 7 lakh rupees of gain. Should be taxable? Should not be taxable? Should not be taxable, because this gain is not realized, not coming in your pocket. Should it be taxed right now on conversion? So conversion of gold into EGR is not going to result into 7 lakh gain which is realized. Yes or no? So this should not be taxable. So this conversion is an exempt transfer. This conversion is an. Now later on, this EGR you are selling. You don't want to have the gold, so you are not getting it converted into gold. You had EGR, you are selling this EGR. So this EGR you sold in 25, 26, yes or no? And EGR you sold for a selling price of 12 lakhs. Because after some time the value of this EGR will also increase, because this value is directly proportionate to the value of gold, yes or no? So if the value of gold will increase, the value of this EGR will also increase. So when the EGR came to you, what was the value of the gold? 10 lakh. 10 lakh worth of EGR was given to you, yes or no? And now the value of the gold has increased to 12 lakh. That means the value of EGR has also increased to 12 lakh. At that time you are selling this EGR for 12 lakhs. Can I say you are having a gain of 2 lakh here? Gain of how much? 7 lakh here. Gain of 2 lakh here. This entire 9 lakh rupees of gain will be realized when you will sell the EGR. So in previous year 25, 26. Are you selling EGR? Is it your capital asset? Capital gain will be calculated. Full value of consideration 12 lakhs. Minus transfer expense nil. Net consideration 12 lakh. What will be the cost of acquisition? Cost of the gold which is converted into EGR will be deemed to be the cost of EGR. So what is the cost of the gold? 3 lakh, which is converted into EGR. That cost will be treated as cost of EGR. So you'll reduce how much? 3 lakh. How much again? 9 lakh, 7 lakh and 2 lakh. This 7 lakh is not taxable at the time of conversion. Realized at that time it will be taxable, and this 2 lakh will also be taxable. Understanding or not? But wait. What will be the period of holding of EGR? 24-25 to 25-26 only, no? Or period of holding of the gold will also be included in the period of holding of EGR. So period of holding of the gold prior to the conversion will also be included in the period of holding of EGR. So period of holding will start from 9-10 till 25-26. Reverse can also happen, you know. Reverse case. What reverse case? You did not buy gold, you bought EGR. EGR you bought in previous year 23-24 at a cost of rupees. Cost was 5 lakhs. How much cost? And this EGR you got converted into gold. You got it converted into what? Gold in the year 24-25 when the value was example 5,60,000. How much gain is happening? Tell me. But this gain 60,000 is realized. Are you selling the EGR to get 5,60,000? No. Today the value of your EGR is 5,60,000. So 5,60,000 worth of gold is given to you. So 5 lakh worth of EGR is going. The EGR whose cost was 5 lakh is going today. What is the value of this EGR? 5,60,000. Against that 5,60,000 worth of gold is given. So 60,000 gain is happening. That 60,000 should be taxable right now. Is this 60,000 coming in your pocket? Realized? This conversion is also exempt transfer. This conversion is also exempt transfer. And now converted gold you are having. Converted gold. If you sell this gold in 25-26 and the selling price was, example, selling price was 7 lakhs. So can I say this gain will realize? And this gain will also be realized. Both the gain will be realized when the gold will be actually sold. Yes or no? And at that time, both the gain should be taxable. So what will be the cost of acquisition of this gold? Cost of EGR on whose conversion you are getting the gold will be deemed to be the cost of gold. Yes or no? So when you will sell the gold in the future, what is the full value of consideration? 7 lakh. Minus transfer expense? Nil. Net consideration? 7 lakhs. Yes or no? What will be the cost of gold? 5 lakh. Cost of EGR which got converted into gold will be deemed to be the cost of your gold. And also the period of holding of EGR will be included in the period of holding of gold. Understanding? So let me put these transactions properly now. Okay. Transaction number 11. Transaction number 11. What is this transaction? Come on, tell me. No. Conversion of gold into EGR. What is that? This is an exempt transfer under section 47. So on this conversion, no need to calculate any capital gain because capital gain will not be taxable. And here cost of acquisition of EGR. Cost of acquisition of EGR. Later on when this EGR will be sold. Okay, no? And later on EGR is sold. Such EGR is sold. Such EGR means which EGR? EGR which you bought? No, EGR which you got on conversion. That EGR you are selling. Yes or no? And if you are selling that EGR, that time the capital gain will be calculated. And to calculate this capital gain, what will be the cost of acquisition of EGR? Tell me. Cost of acquisition of gold which is converted into such EGR will be deemed to be the cost of acquisition of this EGR. Period of holding of Period of holding of EGR shall also include period of holding of converted gold. Period of holding of converted gold. Same thing I will write for conversion of EGR to gold. Yes or no? Same thing. That will be my transaction number 12. Got it? No, sir. So what is my transaction number 12? Tell me. Conversion of EGR into gold. Will it be my taxable transfer or an exempt transfer? Capital gain will arise or will not arise? Copy paste. But I will change the few things. So this is an exempt transfer. Under section 47, capital gain will not arise. Later on search, gold is sold. Capital gain will arise. So what will be the cost of acquisition of such gold? Tell me, cost of acquisition of EGR which is converted into such gold. Yes or no? And period of holding of gold shall also include the period of holding of converted EGR. Done, sir? This is 12th transaction. Now I am going to do the last transaction of section 47. Then section 47 will end and the special aspects will also end. Understanding? So pay attention. This is a senior citizen. Who is this? You know now who is a senior citizen, guys? A person whose age is 60 years or more at any time during the year and who is a resident. That person is a senior citizen. So are you a senior citizen? No. Okay, I am a senior citizen. Okay, I am a senior citizen. Sure, you are not a senior citizen, no? So see, this senior citizen. Have you heard about mortgage? What happens in the mortgage? Tell me. You have one asset that you mortgage with the bank, lender. Yes or no? And in return you are going to get a loan. So asset is given, no? Or asset is still yours. Asset is still yours. But that asset you are keeping as a security. That if something wrong happens, that you fail to repay the loan, you fail to repay the interest, etc., that lender, that bank will have all the power to take back that asset from you, sell it and realize the loan given and interest due. Yes or no? And in the normal mortgage transaction, what happens? You mortgage your asset right now and you take the loan and the repayment of that loan immediately starts along with interest. So right now, for example, if I'm mortgaging my asset with the bank and I'm taking a loan, yes or no? So in that case, whatever loan which I'll be taking from the bank, that loan will be immediately, I will have to start repaying the principal also, and immediately I'll have to start paying the interest also. Getting my point, everyone? But in the reverse mortgage transaction, this will not happen. Reverse mortgage transaction is a transaction of mortgage only. But this is a transaction in which you have to mortgage some asset, and for that mortgage you are going to get loan only. On that interest, etc. will also be charged. But that loan, principal amount as well as interest, you don't have to start repaying immediately. Time will be given. How much time? 20 years. How much time? Within 20 years. If you die, 20 years is enough. No, you are a senior citizen. How much bloody you are going to live? Are you going to live for 500 years? Already bloody your age is 60 or more. Hello? The God is already has started giving you missed calls. Now, a final call will also come. And that can happen within next 20 years. 20 years is a good amount of time. Yes or no? See, what if that senior citizen lives beyond that 20 years? That is a different case. I'm going to tell you about that. Okay, no? But see, the senior citizen, no? Senior citizen will have to mortgage one asset. So whatever I'm telling you right now, it is a reverse mortgage scheme of the central government. Which scheme? The name of the scheme is reverse mortgage scheme. Reverse mortgage scheme. This scheme is made by central government, and this scheme is made for the benefit of everyone, no? Only senior citizen. All senior citizen? No. Only those senior citizen who are the owner of residential property. All the senior citizen cannot take the benefit of this scheme. Only those senior citizen can take the benefit of the scheme who are the owners of a residential property. So, Mr. Senior Citizen, are you having a residential property? Yes. So do one thing. Mortgage. What did I say? Mortgage the residential property with approved banks or financial institutions. Now these banks and financial institutions will be approved by the central government under the reverse mortgage scheme to take such type of mortgages from the senior citizens. Yes or no? So the banks or the financial institutions which are approved by the government, to those approved banks or financial institution, you are supposed to mortgage your residential property. The moment you will mortgage your residential property, no, what this bank will do, what this financial institution will do, they will give you either any lump sum amount, or they will start giving you a regular payment in the form of annuity. This is as good as loan given to you. This is as good as loan given to you against your property. So, senior citizen, if you don't have any source of income as of now, so from where you are going to meet your expenses? Regular expenses are happening on your medical treatment, medicines, your maintenance expenses are happening. For example, your property requires repairs and all. So from where you are going to get that money? At this age, you don't have any source of income. So, for safeguarding your old age life, this scheme has come. If you have done a good work in your entire lifetime, what good work? That you have acquired a residential property on your name. Just give that residential property as a mortgage. Just keep that property as a mortgage with these type of banks or financial institution. These banks, if you want, they can give you a lump sum amount also. And if you want, these banks can give you a regular amount on a monthly basis as annuity. This is as good as loan given by them to you. Yes or no? But don't worry. They are not going to ask you to pay this amount plus interest immediately. 20 years time will be given. How much time? So from the date of taking this amount, from the date of giving the property on mortgage, from that date, 20 years will be counted. How many years? Within the next 20 years, we have told these banks or financial institution not to go to you. Nobody from the bank side will come to your doorstep asking for the principal amount, asking for the interest amount. See, we have given you lump sum. We are giving you annuity. That is as good as loan. Start repaying. Give the interest. No, nobody will come to your doorstep asking for this amount. For the next 20 years. We guess 20 years are enough for you. Hello? Sir, 20 years enough. You are already a senior citizen. So within next 20 years, whenever you die, within next 20 years, whenever you die, and there is no dependent staying in that property, that property will now go to bank. Bank will sell that property. Bank will sell that property, recover the loan amount given to you along with the interest, and whatever balance will remain, no excess amount, that will be given back to your legal heirs. That will be given back to your legal years. This is the benefit of the scheme. So till the time you are alive, you are not supposed to worry about the repayment of the loan and the interest. And by the way, you are not going to take this property with you to the heaven, no? The property will remain here. So that property will belong to the bank. And now bank will sell that property and recover the loan and interest. And whatever excess amount will remain, don't worry, nominate someone as your legal heir, that amount will be given to that legal heir. But wait. Before selling that asset, before selling that residential property, the bank will give option to your legal heir that if your legal heir pays back that loan and interest, then the bank will not sell the property, bank will give that property to your legal heir. But this everything should happen within 20 years. You should die within 20 years. The property will go to the bank within 20 years. Bank will sell within these 20 years. Meaning under the reverse mortgage transaction, within the span of this 20 years, if all these things happen. So any transfer of this residential property in the scheme of reverse mortgage transaction will be an exempt transfer as per section 47. As per section 47, transfer of what? Residential property. So when you will die, the property will go to bank. Transfer is exempt. Bank will sell the property to recover the loan and interest. Within 20 years if the bank is selling, yes or no? Transfer is exempt. Or if your legal heirs will pay the loan, so the bank will transfer that property to your legal heir. Transfer is exempt. Any transfer of this residential property under the reverse mortgage scheme is an exempt transfer. Will not attract any capital gain. Will it attract capital gain in your hands? After you die and the property will go to bank. Bloody after your death. From whom we are going to ask for tax. So it will not be taxable. Exempt transfer. Will it attract capital gain in the hands of bank if the bank will sell the property to recover the loan and interest? No. Because bank is selling the property. It is just taking the loan amount back and the interest amount back, and the remaining amount the bank is going to give to your legal heirs. So this transfer is not taxable in the hands of bank also. If your legal heirs pays that loan and interest, so the bank will transfer the property to your legal heir directly. Will it attract any capital gains in the hands of bank? No. Transfer is exempt. Understanding? So transfer is exempt. So when this what did I say? Any transfer of such residential property under the RMS means reverse mortgage scheme will be an exempt transfer under section 47. Will there be any capital gain calculated and taxable? The answer is no. Okay. Now you might have one question here. What question? Sir, the bank which is giving lump sum and annuity to this senior citizen, will it be taxable as income in the hands of senior citizen? Property given on mortgage. So now the bank will give the money to whom? To the senior citizen. Yes or no? In the form of lump sum, in the form of annuity. So will this amount be treated as income and taxable in the hands of senior citizen? The answer is no. This will be fully exempt in the hands of senior citizen for senior citizen under section 10 subsection 47. There is one section 10 subsection 47. As per this section, this entire amount will be exempt. But wait, this will be exempt in your hands if you don't use this money for speculation, gambling. Appa, look at your age. Bloody for your benefit, for your old age, to meet your regular maintenance expenses, medical expenses, we are going to give you this benefit. And under this scheme, if you are coming and taking this money and using that money for speculation, gambling, then this exemption will not be available. This exemption is available provided this money which you are getting, you are going to use that money for your medical treatment, medicines, then your regular maintenance expenses, repair of your house, etc. Yes or no? But if this amount is spent by you for speculation, gambling, etc., then this amount will not be exempt. At this age, go to temple instead of doing all these things. Huh? Taking this money, doing speculation, gambling, will not give you an exemption. Understanding this? Everyone? Now tell me, how much maximum time is given? For maximum time of this scheme is 20 years. For 20 years, no need to repay the loan and no need to repay the interest. Within 20 years, but you have to make sure that you die. Then only all these things will happen. Ayyo. But what if you survive? So 20 years are about to get over. So this senior citizen stood on the railway platform like this. 20 years are about to get over. Let me die. Train stopped. He did not die. He jumped from 15th floor and below it was water. So he did not die at that time also. He tried his level best to die within 20 years, but still he survived. Shit, I survived 20 years. What to do now? Now the government says that sorry, Appa, we cannot stop the bank now. We have already stopped the bank for 20 years. Now God has gifted you with such a long life, no? That you don't die within 20 years. So now we'll not be able to hold the bank back from recovering the loan and interest. Now the bank people will come. They will transfer the property. They will make you transfer the property after 20 years to recover their loan and interest. Now the property is sold on your death or when you are alive. And it is sold on your name only, but the bank will get it happen. Yes or no? Now if the property is transferred, no, then this transfer is not an exempt transfer because this is not happening in the reverse mortgage scheme within the period of that 20 years. Because you are surviving for those 20 years, yes or no? And what happens? After 20 years, the bank is getting it sold, but bank will not sell it on its own name. Bank will tell you to sell. Appa, please sell the property now. Now after 20 years, the value of the property would be very high. Okay, sell the property, we will recover the loan and we will recover the interest. Whatever excess amount remains now, from this excess amount, whatever balance life is remaining with you now, you can very well spend your balance life with the balance amount remaining. That will be a good amount, very good amount. Now stay in a rented premises, stay in some old age home, yes or no? But see, some senior citizen will be very reluctant. Oh, at that time, why would I stay in someone else's house? Then you have other option. Then you have other option under this scheme. And that is unlimited validity. This is 20-year validity, no? That other option will be unlimited validity. Now in that unlimited validity, what will happen? See, first, did you understand this? So if this thing happens within 20 years time, yes or no, then the transfer is exempt. But if 20 years over and within 20 years, if senior citizen dies, okay, no, dies and no dependent living in such property, then the bank will transfer such property, okay, and then the transfer will be exempt transfer. If 20 years over and senior citizen is still alive, now the transfer of property will take place on the name of such senior citizen, and this will be exempt transfer or not an exempt transfer? Under section 47, this will not be an exempt transfer. Therefore, capital gain will arise and it will be taxable in the hands of senior citizen. Getting my point? And after paying capital gain tax, after paying the loan amount, interest amount, still good amount will remain in the hands of senior citizen, and your remaining period, remaining life can be easily spent with that amount. That much amount will be remaining. Don't worry about that. Okay. Now see, there is another option. Unlimited validity. Unlimited period. First period was 20 years, no? Now, this is a second option in which unlimited period is there. So now what this senior citizen will do? This senior citizen will mortgage the residential property. Tell me. Mortgage residential property. To whom the property will be mortgaged? Approved bank or financial institution? Yes or no? And in return, instead of giving him the amount, no. Now the amount will not be given to him. In this option, the amount of loan will not be given to him. What this bank will do, financial institution will do, it will invest. It will invest on behalf of such senior citizen in any annuity. What did I say? In any annuity sourcing institute. Annuity sourcing institution. Now this annuity sourcing institution can be any mutual fund, can be any insurance company, yes or no? So that mutual fund, insurance company is known as what? Annuity sourcing institution. So now whatever amount which we were supposed to give you, we are not going to give you that amount. Instead of giving you that amount, we will invest that amount on your, so the loan amount, instead of giving it to you, that loan we are going to invest on your behalf in any annuity sourcing institution, so that from this institution, regular annuities means pension are given to you till such senior citizen is what? Alive. Till the time you are alive. Now you can stay alive. You can die within 20 years also. You can die after 20. Whenever you want, Appa, you can die at that time. Okay? Whenever you want, you can die at that time. Okay? And till the time you are alive, you will keep on getting what? A regular payment from this annuity sourcing institution in the form of annuities. And for your kind information, this annuity will not be exempt under section 1047. There will be no exemption. This will be taxable in the hands of that senior citizen under the head IFOS. And now, once this senior citizen dies, now whenever that senior citizen dies, within 20 years, after 20 years, because this is an unlimited expiry period, no? Hello? So now, whenever such senior citizen dies, property shall be taken by the bank, in its own custody and transferred. This transfer is exempt transfer under section 47. Capital gain will arise or will not arise? will not arise because this transfer is happening under the scheme under the second option. So in the first option, if the transfer takes place within 20 years, then the transfer is exempt. In the second option, if within 20 years the senior citizen dies and the transfer takes place in the first option, yes or no, then the transfer is exempt. But in the second option, whenever the senior citizen dies and the transfer takes place, that transfer is exempt. Understanding? But in the first option, if the senior citizen survives and he does not die for 20 years, then after the expiry of 20 years, now the property will be transferred. That transfer is not an exempt transfer, that transfer is a taxable transfer. In the first option, the amount will be directly given to the senior citizen in the form of lump sum or annuity. That will be an exempt income in the hands of senior citizen. Yes or no? Hello? That will be an exempt income in the hands of senior citizen. But in the second option, the amount of loan, instead of giving to the senior citizen, that amount will be invested in any annuity sourcing institution on behalf of the senior citizen, and from that annuity sourcing institution, regular income will go to senior citizen, okay? And that income will not be exempt, that will be taxable as IFOS income. And whenever that senior citizen dies, the bank will take that property under control and bank will recover the amount of loan which the bank had invested along with the interest. And whatever excess will remain will be given to the legal heirs. And if the legal heirs pay the loan as well as the interest, so instead of selling that property, the property will be transferred to the legal heirs. Any transfer of the residential property under the reverse mortgage scheme will be an exempt transfer. Capital gain will not arise. Understanding? Hello sir. This was the last transaction under section 47. And section 47 comes to an end. Special aspects comes to an end. Now one simple question I'm asking you. You give me an answer, okay? 47 is over, okay? Do you remember one provision we did in that one transaction, fourth transaction, if you remember? If I'm an individual or HUF, I am giving my asset to you by way of gift, will, inheritance, irrevocable trust. So that transfer is an exempt transfer for me. Hello? And for you, 49(1) will apply. So you are a transferee. Have you received the asset by way of mode specified under section 49(1)? So for you, what will be the cost of acquisition? Cost to previous owner. So whatever will be my cost will be deemed to be your cost. My cost of improvement will also be treated as your cost of improvement. Yes or no? My period of holding will also be included in your period of holding. Do you remember that? What if you don't know what was my cost? Then there is one section 55 subsection 3. Which section? Which says that if the cost to previous owner is not known, if the cost to previous owner it is not known that at what cost the previous owner acquired. So will you be able to take your cost? No. As per 49(1) you have to take my cost as your cost, no. So if my cost is not known, then the fair market value of that asset as on the date on which the previous owner acquired, he would have definitely incurred this much cost, no, minimum this much cost. So this will be treated as your cost of acquisition. This will be treated as cost to previous owner and will be ultimately treated as your cost of acquisition. Understanding? So there is one section, section 55 subsection 3, which says that if cost to previous owner cannot be ascertained, meaning not known, yes or no, then in that case the fair market value as on date of acquisition by the previous owner may be taken as what? Cost to previous owner. And once this amount is taken as what? Cost to previous owner, and ultimately this amount you can also take as your cost of acquisition as per 49(1). Understood? Sure, sir? Done. All these special aspects done. Now see, there is one section 49(4) which I have just now left. Next chapter we are going to do no IFOS. In IFOS, I am going to cover this 49(4). Very important section. But if I tell anything about this right now, no, so you will unnecessarily be confused because you don't know the gift provisions of IFOS. So first I will have to teach you gift provisions of IFOS, and in that gift provisions of IFOS, I will introduce this section 49(4) over there. Then what I will do, in the IFOS, no, I will link up capital gains and IFOS, gift provisions. And that linking up is very important. Because on that linking up also, few questions are there. And they can ask those questions also. What will happen in the hands of transferor? And what will happen in the hands of transferee? In the hands of transferee, gift provisions will apply or will not apply. If applies, then what will be the cost? If does not apply, then what will be the cost? In the hands of transferor, whether the transfer is an exempt transfer or not. If it is an exempt transfer, definitely no capital gain will arise. But if it is not an exempt transfer, how the capital gain of the transferor will be calculated? All these things we are going to learn when we are going to do the gift provisions. So that will be the last point of IFOS chapter. In the IFOS chapter, when we are going to do the gift provisions, that time I am going to discuss this section 49(4). Everyone understood? Now let's move on to the next part of the chapter, section 54. Now fourth part of the chapter, exemptions. You remember exemptions? I told you that we are going to do the exemptions also. But these exemptions, before this, whatever the balance questions are there, no, let us finish those questions first, okay? Question number 1, illustration number 1. Come to illustration number 1. We have done that illustration number 1. One small part of that illustration number 1 was remaining. Do you remember? Page number 3.384. How will you calculate the period of holding of such? Period of holding in the case of following assets. Shares held in the company in liquidation. Do you remember section 46 we did? So if the shares are held in the liquidating company and you are a shareholder, so will you surrender those shares on liquidation? And in return you are going to get what? Cash. You are going to get assets, and based on that your capital gain of the shares will be calculated. So what will be the period of holding of those shares? The date on which the shares are acquired by you, either the date of purchase or the date of allotment. From that period, from that date, the period of holding will start and it will end on date of liquidation. Meaning the period of holding after the date of liquidation will not be included in the period of holding of such shares. Did I tell you already? Today read that at home. Okay. What will be the period of holding of the bonus shares? If purchased, then date of credit in the demat account, and if listed, then date of credit in your demat account. If unlisted, then date of allotment. What is the flat in a cooperative society? The date on which you get the right of ownership by becoming the member. That is the date on which you acquire that is the date on which the period of holding will start. Till the date you transfer that right of ownership. Yes or no? Understanding? So this is your illustration number 1. Now come to illustration number 2. That we have done. Hello? So illustration number 1 was for period of holding. Write down POH, period of holding. Illustration number 2. Done. That is for conversion of capital asset into stock in trade. Illustration number 3 is also for conversion of capital asset into stock in trade. We have done 3 also, no? Have we completed 4? Come to question number 4. Illustration number 4. Illustration number 4 on your page number 3.393. M held 2000 shares in a company ABC Limited. Do you remember Kamal's example I took? Kamal held how many shares? 1000 shares of X Limited. In lieu of these shares, sorry, he is giving these shares in lieu of 1200 shares of the amalgamating company. Do you remember that? Yes or no? Now read. 2000 shares in a company ABC Limited, an Indian company. This company amalgamated with another Indian company XYZ Limited. So he is already having 2000 shares of ABC Limited. And now the amalgamation of this company is taking place with XYZ. Can I say XYZ Limited is an amalgamated company? Yes or no? Now this amalgamation is taking place during the previous year 25-26. Under the scheme of amalgamation, M was allotted how many shares? So he will give his 2000 shares and in return he will get, will this transfer attract any capital gain? 2000 shares given and in return he is getting 1000 shares. Old shares given, new shares coming. Will this transfer be a taxable transfer or an exempt transfer? So this transfer will be an exempt transfer. No capital gain will arise in this case. Yes or no? So the market value of the shares allotted is higher by 50,000. Oh, so for example, these 2000 shares was, cost of acquisition was 1 lakh. And in return you are getting how many shares? 1000 shares. Okay. For example, the 1000 shares, fair market value is 1 lakh 50. So the value is more than 50,000. So cost of the 2000 shares was 1 lakh. Against that the shares, 1000 shares are coming of XYZ. The value is more by 50,000. Meaning appreciation is how much? 50,000. Now they are saying the assessing officer proposes to treat the transaction as exchange and to tax 50,000 as capital gain. Is he justified? The answer is no. Mr. M will go to the assessing officer, will give him a tight slap with right hand and a tight slap with a left hand and will show him section 47 and he will say that, see bro, the shares of old company are given in lieu of shares of new company, then whatever gain arising, that gain cannot be taxed because this transfer is an exempt transfer. So the action taken by you is not justified. That's why 1 slap, 2 slap. Will you be able to write down this answer? 1 slap, 2 slap you will write? No, the assessing officer is not justified in charging that gain under the head capital gain because the transfer which is treated as an exchange by the assessing officer is an exempt transfer under section 47. Hence the gain cannot be charged in the hands of Mr. M. Simple 2 to 3 line, you will get full marks. Understanding? This illustration number 4 is done. Now come to illustration number 5. Very difficult, huh? Very difficult. Don't tell me then. Which of the following situations capital gain tax liability does not arise? Hey, you are supposed to tell in which of the transaction it will not arise. Okay. First transaction. A purchased gold in 1970 for how much? In the previous year 25-26, meaning in this year, he gifted it to his son at the time of his fair market value of the gold on the day of gift was 1 lakh. Oh, 25,000 lakh he bought. And today, when he is transferring to his son by way of gift, the value is 75,000 appreciation has taken place. That 75,000 will be taxable in the hands of Mr. A. Or will not be taxable. Because Mr. A is giving the asset in the form of a gift, which is an exempt transfer. Capital gain liability will not arise. Understanding? So in the year 25-26, when Mr. A is transferring, no capital gain will arise in the hands of Mr. A, since this transfer is an exempt transfer under section 47. Now, a house property is purchased by Hindu undivided family in 1945. Ayo, long back. 1945, the house property was purchased by whom? HUF. For how much? It was given to one of the family members in the previous year. This year, at the time of partition of the family, fair market value on the date of partition was 12 lakh. Ayo, 11 lakh 80,000 gain. Should be taxable in the hands of HUF right now. because that is realized and coming in the pocket of HUF right now. Is the HUF earning 12 lakh rupees? So that gain is realized, coming in the pocket. Should it be taxed or it should not be taxed? Hence this transaction is also an exempt transfer under section 47. Any transfer by an HUF to its member of any capital asset at the time of partition is an exempt transfer. So this transfer taking place in 2025-26 will be an exempt transfer in the hands of HUF. No capital gain will arise. Understanding? Next one. Mr. B purchased 50 convertible debentures for rupees in the year 1995, which are converted in this year into 500 shares worth rupees 85,000 in November 25. So this year conversion of those bonds is happening in shares. So bonds are going. What is the cost of the bonds? 40. Against that the shares are coming. What is the value of the shares? 85,000. Gain is 45,000. This gain will be taxable right now on conversion. Gain is realized, coming in the pocket, not coming, so should not be taxable. Hence this conversion is also an exempt transfer as per section 47. So this 45,000 gain will not be taxable right now because this transaction is an exempt transfer. This 45,000 will be taxable later on when these shares will be sold. At that time the cost of those shares will be 40,000. The cost of the debenture will be deemed to be the cost of those shares. At that time this gain will be taxable, but not now, because right now this transfer is an exempt transfer. Will you remember this thing? Now can you see how the transactions are becoming easier for you? Okay, so illustration number 5 is also done. Come to the next illustration, sixth one. Oh, Mr. Abhishek, senior citizen, mortgage his residential house with a under a notified reverse mortgage scheme. Very good. He was getting a loan from the bank in monthly installment. First of all, tell me, he was getting a loan from bank in a fully exempt. The amount of loan which he will get from the bank, either lump sum or monthly installment on mortgaging his property with the bank, that will be fully exempt, will not be taxable for him. Yes or no? Then Mr. Abhishek did not repay the loan on, how much was the maturity? 20 years. So 20 years gone. We had given you 20 years time. Maturity has come and you have not died, and loan is also not paid, and hence gave the possession of the house to the bank to discharge his. So now bank will sell the property on the name of this senior citizen. So property is being sold on maturity, meaning after 20 years. Will this transfer be an exempt transfer? Is the transfer happening under the reverse mortgage scheme within 20 years or on maturity? After 20 years. Yes or no? So now the bank will take the possession of the property and will sell the property on the name of the senior citizen. This transaction is not an exempt transfer in the hands of senior citizen. The capital gain will arise and will be taxable. Understanding? How will the treatment of long? Guys, will the transaction attract capital gains? The answer is yes. See, monthly installment amounts received by Abhishek would not be taxable. It will be exempt under 1043. See, in my notes now, I have by mistakenly written what? 1047. Please make it 1043. Huh? It was my mistake to write down the section number. It will be 1043 instead of 1047. Here also, please rectify. This is 1043. Done, sir? Now, see, in this question, they are saying that section 47 provides that any transfer of a capital asset in a transaction of reverse mortgage under a scheme made and notified by the central government shall not be considered as a transfer of for the purpose of capital gain. Accordingly, the mortgaging of the residential house with the bank by Mr. Abhishek will not be regarded as transfer. Therefore, no capital gain will be charged on such transaction. Giving on mortgage will not be a taxable transfer. It will be an exempt. So when the property is given on mortgage, Property is not transfer. It is an exempt transfer. When he dies and the property comes in the hands of bank, then also exempt transfer. Yes or no? And if the bank sells that property, then also exempt transfer. Getting my point? And when the bank gives the property to the legal heir, then also exempt transfer. Getting my point? So now, go and read illustration number 7. Illustration 7. Examine with reasons whether the following statements are true or false. First you are supposed to say, is it true or false? And then you are supposed to give the reason also. Yes or no? Alienation of a residential house. Alienation means transfer. Yes or no? In a transaction of reverse mortgage under a scheme made and notified by the central government is treated as what? Transfer for the purpose of capital gains. No. It is not a false. Okay, now? It is not a transfer. It is an exempt transfer. Yes or no? Zero coupon bonds of eligible corporation held for how many months? Will be long-term capital asset. Yes. Because for zero coupon bonds we check period of holding of 12 months. If they are held for more than 12 months, they are long-term capital assets. So this statement is true. Next one. Zero coupon bonds mean the bond on which no payment and benefits are received or receivable before the. Absolutely correct. Whatever benefit will come at the time of maturity in the form of gain. Until the time of maturity, no benefit will be given in the form of interest, etc. So the statement is true. Understanding? This is false. This is true. This is true. And the reason we have already discussed. Okay. Come to illustration number 8. 8 is done, I guess. 9th is also done. 10th is also done. 11th, not done. Come to 11th. 11th is a very difficult question, I guess. Let's see what happens in 11th. 11th is on page number 3.439. 11th one. Oh, now this 11th involves section 54 exemption. So with section 54 exemption, we are going to do illustration number 11. Okay, now all the remaining questions will require your exemption. Okay, this will talk about section 54 EC exemption. There is one section 54 EC exemption. After that we are going to do question number 12 also. Then after question number 12, illustration number 13 is there. Illustration number 13. Mark that illustration important. 13th one. IMP. And this type of similar question came in the exam for how many marks, 10 marks. Yes. Very easy. Very, very easy. Tomorrow, I'm going to tell you about the tax rates. Tax rates which you know, na? So tomorrow we are going to discuss about the exemptions also and the tax rates also. So after doing exemption, those two questions will be completed. Okay. And when I tell you about the tax rates, one or two important discussions we are supposed to do. And once we'll do that discussion, only then we'll come to this question and it will make sense. Because 2-3 important points I'm yet to discuss with you for the tax rates. Getting my point? So let me do that part, then we'll come to this. So how many illustrations are remaining? 11 is done, no? 11, 12 and 13. 3 illustrations are remaining. Tomorrow it will be over. Okay. Now let's come to the test your knowledge part. Test your knowledge. Question number 1 is done. 2, 3, 4 done. 5 not done. Okay. First of all, let me read the question first. Oh, wait. In section, here there is a section 54 exemption in this question also. Question number 5, there is a section 54 exemption. Okay, no? In this question, there is section 54 and 54 EC. Both the exemptions are there in this question. And question number 7 we have completed today. Question number 8 we have completed today. Only few questions are remaining and some discussion about the exemptions. Okay. So first of all, tell me how many exemptions we have already seen in this chapter. See, if you remember now, I have already told you one exemption, 1037. 1037. I have already told you about that. 1037 if you remember. Do you remember 1037? You are an individual or an HUF. Your urban agricultural land is compulsorily acquired under any law, and that urban agriculture. So guys, see what I was saying, that we have already seen few exemptions under this chapter. But those exemptions we have seen under section 10. There was one 1037, there was one 1034A, and there is one 1043. Okay, and there was 1038 also. 1038 is no more in existence. But we gave the reference to this while doing LTCG under section 112A, grandfathering, if you know. Grandfathering the gain, which was for the period for which it was exempt. That gain should not be taxable. So cost of acquisition as per 55(2) AC will grandfather that gain. Because of that cost, this gain will not be taxable. Even if the asset is transferred, even if the listed equity shares are transferred on or after 1st April 2018, and the long-term gain is calculated under section 112A, this gain which was earlier exempt under section 1038 will no more be taxable. Grandfathered gain, yes or no? Grandfather means old, retired. Understanding? So next one, 1043, just now only, 2 minutes back. 2 minutes back. Senior citizen, given your property on mortgage to any bank or financial institution, that bank is giving you loan in the form of lump sum, annuity, so that annuity amount or the lump sum amount, if you don't use that amount for speculation, gambling, etc., then that amount will be exempt in your hands as per section 1043. Do you remember that? Then 1034A, it was applicable till last year. This is no more in existence. But we have taken the reference of this while doing buyback. You remember? Up to 30th September 2024, if the domestic company is doing a buyback, then buyback price was taxed in the hands of company. That buyback price was exempt under 1034A in the hands of shareholder. But this exemption is no more applicable with effect from 1st October 2024. Do you remember this? So this section will not come in your exam. This section will not come in your exam. But they can ask you this, they can ask you this. This 1037 was, you are an individual or HUF, you are having urban agricultural land that was compulsorily acquired under any law. That urban agricultural land was used for a minimum period of 2 years or more immediately prior to its compulsory acquisition. Then whatever short-term gain or long-term gain which you are going to calculate under section 45(5) on compulsory acquisition, yes or no? No need to calculate, that is fully exempt, provided the compensation for that compulsory acquisition is approved by central government or RBI. I have already told you, decided by the central government or RBI. Then based on that compensation, whatever gain you are going to calculate under section 45(5), whether short term or long term, will be fully exempt. So no need to calculate that gain or short term gain or long term gain. Understood? So this was your 1037. See, these are the exemptions which are already available under section 10 for your capital gains. Getting my point? But there are certain exemptions which are given from section 54 to 54 GB. But out of those exemptions, you are supposed to do 54, 54B, 54D, 54 EC and 54F. How many exemptions are there? Only 5 exemptions are there, and very easy. I'm telling you, very easy. If you'll go in the exam now, doing the entire capital gain chapter, and if you'll skip these exemptions, now trust me on this, you'll be able to solve only half the question. Because confirm in the capital gain chapter, majority of the questions, they will test you for these exemptions also. Because what the student does, the student will read or study the entire capital gain chapter, and he will put these exemptions in the option. And that your institute knows very well. So whenever they will frame a question, no, they will try their best that in that question they exploit these exemptions also. So if you have, done so much of hard work in the entire chapter, then don't leave these sections. These sections are really important. But out of all these sections, no, see, you have to focus on section 54. If you learn section 54 properly, no, trust me, all the other sections will be a piece of cake for you. Because only some information will change, rest everything will be same. Understanding? So now see, here no, under section 54. I'm just giving you a basic idea about these sections right now. In detail we are going to discuss these sections tomorrow. So this is your long-term capital gain is exempt. Long-term capital gain on residential house property. This section will exempt your short-term or long-term capital gain on urban agricultural land. In this section, short-term or long-term capital gain on land or building used for industrial purpose. Which purpose? Industrial purpose. 54 EC will exempt the long-term capital gain on immovable property. Which property? Immovable property. And 54F will exempt your long-term capital gain on any capital asset other than residential house property, because that gain is already exempt under section 54. So long-term gain of residential property, already we are giving you exemption under 54. Claim it there, no? For other long-term gains of other assets, 54F will be given. Now see, how many sections are repeatedly asked in the exam? Repeatedly. This and this. Most IMP. Repeatedly you will get these two sections in the exam. And along with that, this section is also important, because there is a separate type of calculation of capital exemption in 54F. See, in all the sections the exemption calculation is same, but the exemption calculation will become a little different in 54F. Hence that section is also important. In the examination, if you expect these sections are asked multiple times. That does not mean that you will keep both the other two sections in the option. We are going to do those sections also. We are going to learn them. But which sections are repeatedly asked? 54 and 54 EC. Repeatedly asked. And your focus should be on section 54. You have to learn that section very properly. And if you learn section 54 now, trust me, all the other sections will be very, very, very easy for you. Now section 54 will give you an exemption for which gain? Any capital gain you can claim as exempt. As per section 54, you can take the exemption of long-term gain only. And long-term gain of any capital asset? No. Long-term gain of any residential house property can be exempted under section 54. But to get this exemption, no. To get this exemption, you will have to do the investment. So invest your long-term gain somewhere and take the exemption of that long-term gain. Easy. So where will you invest? the long-term gain of residential property, invest in other residential property. You will get exemption under section 54. So investment in residential house property. So sell the old residential house property, acquire the new residential house property. So the gain of long-term gain of old property will be exempt because it is invested in new residential property. It is that long-term gain is converted as cost of new residential property. Hence it will be exempt. Now, can you have short-term or long-term gain on urban agricultural land? Hello? Then invest that gain in any agricultural land. Any agricultural land. That agricultural land can be urban as well as rural. By the way, rural agricultural land is not a capital asset. So when you will transfer the rural agricultural land, no gain will arise. Yes or no? But urban agricultural land is a capital asset, no? If urban agricultural land is transferred, capital gain will arise. Short term or long term, that gain will be exempt if you invest that gain in other agricultural land. That other agricultural land can be urban, it can be rural also. Now, do you have any short term or long term gain on any land building or land and building which you are using for industrial purpose? So that gain also we are going to exempt if it is invested in land or building for industrial purpose. So old land or building of industrial purpose is transferred, gain is happening, that gain you again reinvest in new land or building for industrial purpose. Then that gain will be exempt. But for that, the gain should arise on compulsory acquisition. Only compulsory acquisition. So this gain, if you want to claim as exempt, this gain should be arising on compulsory acquisition. Then only that gain will be exempt. Provided it has to be invested in another land or building for industrial purpose. Now, do you have any immobile property? Yes. Long-term gain of immobile property, you invest in notified bonds. Notified bonds. Now, there are many bonds here. NHAI, RECL, NHAI means National Highways Authority of India, RECL, Rural Electrification Corporation Limited. Then there is Power Finance Corporation, PFC. Then there is IRFC, Indian Railway Finance Corporation. Then IRDA. Then there is bonds of HUDCO, Housing and Urban Development Corporation. Yes or no? These 6 bonds are notified. So your long-term gain of immobile property, any immobile property, if you invest that long-term gain of immobile property in these bonds also, no, then also your long-term gain will be exempted. Understanding? And last but not the least, long-term gain of any capital asset other than residential property. So long-term gain of shares, long-term gain of jewelry, long-term gain of land, any asset other than residential house property, you have to invest the long-term gain. Now invest the net consideration. What did I say? Invest the net consideration of this asset. Invest the net. In all the sections you invest long-term gain. You invest your gain. But in the last section they are saying you are not supposed to invest the gain. You are supposed to invest the net consideration. And your net consideration if you invest in what? Residential house property. So net consideration of any asset. You invest in residential property. Your gain of that asset we will exempt. Net consideration of any asset you invest in residential property, then the gain of that asset we will exempt. Full net consideration if you invest, full gain we will exempt. Part of the net consideration you invest, part of the gain we will exempt. This way. So this is your entire section 54. Now, who can take this exemption? Who can take this exemption? What all other things are supposed to be remembered? In how much time the investment should be made? Yes or no? For investment also the time limit is given. If investment could not be made within certain time, then what will happen? Any other option is there or not? Then if the new asset is purchased, what is the lock-in period? If that new asset is transferred within that lock-in period, what will happen? Yes or no? All this discussion will happen with these sections. But you have to focus on first section. If you focus on first section, that is the difficult section, difficult as compared to others. Yes or no? And that is the base for other sections also. If you learn that, no, all the other sections will become piece of cake, will be very easy. So tomorrow we are going to start with section 54 and we'll end this chapter. I'll try my level best to finish that chapter in the first session only, so that from the second session we can start with the new chapter. Okay? See you all tomorrow. Bye bye.